So in order to understand how this strategy works, you need to understand what is a compression. As you can see, you have your bullish trend right here with multiple swings, and now your swings are much smaller. So what is this? This is a squeeze. This is a trap. Price is trapping price action with a fake point of indecision. Even though the direction of price is intended, this is the last attempt to fake out traders before the expansion. So as you can see here, price is pretty simple to read. You can see clear swing highs and clear swing lows. But now you can see price getting tighter. You can see price coiling up. This would be your compression. So what's the why behind compression? So let's say you are on the daily time frame. So this would be your daily time frame, and you can see clear swing highs, swing lows, swing highs, and swing lows. So you can see clear structure on your daily time frame. And now out of nowhere, price changes profile and starts making micro swings that are barely visible. So what's going on here? So what's happening here is the exact same thing that's happening here. There's still structure in this compressed price action, but to view it, you would have to go from the daily to, let's say, your 4-hour. Now, if you go on the 4-hour time frame, you would start seeing this structure more clearly. So you would start seeing clear swing highs and swing lows. So what does this tell us? This tells us that the operating time frame changed. So price is compressing, there's less orders in the market, and this is an indecision point. So price will compress for a little bit and out of nowhere, go back to its original profile. Before you proceed, please make sure you like the video and leave a comment. This helps us continue making these videos. So let's talk about what actually happens during a compression. And we're going to explain this via weakened supply and weakened demand. So as you can see, you have your bullish trend, and out of nowhere, your swings got smaller. So what happened here? Price rejected from your extreme supply, but now price is being met with your extreme demand. Now your demand overpowers your supply to continue the bullish trend. So as you can see here, the trend is clearly bearish, and now price is failing to break to the downside, creating your extreme demand. Price reacts with your extreme demand and fails to break structure, and now uses your extreme supply to continue the bearish trend. So in case you're still confused, let me explain this in simple terms. So let's say you are in a bearish trend and price is bearish. So now when it's time for your compression, price makes a swing high, swing low, swing high, and fails to continue the bearish trend. Why did price fail to continue the bearish trend? Because price got met with demand. What happens here? What happens at a demand? Price is purchased. So you can say that there is buy orders here. Now we don't know the amount of buy orders, but we know that there are buy orders here that will push price to the upside. So now price goes into a micro rally. Now price fails to break this swing high. And why did it fail to break the swing high? Because price got met with your supply. So now you have sellers versus buyers. So this is where you would have sellers. This is where the sell orders are. So now, since the trend is already bearish and the institutions want to continue price to go bearish, your supply will overpower your demand. And all the buy orders that were injected here were used for this micro rally. They were used for this micro rally. So once the sell orders came in, the sell orders were much greater than your buys. So the sells were much greater than your buys. And price continued to the downside. So remember, in a compression, price would move from extreme to extreme. So if it's a bullish trend, price would move from your extreme supply, which would be your premium, to your extreme demand, which would be your discount. And if it's a bearish trend, price would move from extreme demand to extreme supply. So let's take a look at this example. So first thing you want to do is before looking for your setup, you want to make sure your higher time frame is in line. So first thing you want to do is look to the left here and you see that we are undergoing a macro purge. So this will be our macro purge and you would be bearish all the way up to this point right here, which would be your bottom quarter. So you are bearish up to this point. And what do we have as far as positioning? And we'll cover this in the next segment. You have a break of structure right here. So what are we looking for now? We are looking for a compression. And what are we looking for as far as our setup goes? We're looking for, since this is a bearish trend, we're looking for a bullish rejection, which would be a demand rejection, extreme demand rejection, to be met with an extreme supply rejection and counter your buys. So your sells overpowering the buys. Now, what do you have here? Rejection. Let's see if it comes out. And now price is being met with your sells. So now your buys here are being met with your sells. This will be your top quarter and price is being met with your sells. So you're trying to take price below this squeeze, and below the squeeze will be right here. And as far as your stop loss, where would your stop loss go? Always look for a high rejection level. So as you can see here, what happened? Let's remove this. Price came up to this level once, rejected, came in this level again, came out. Again, rejection prior to a breakout, expands, break structure, and rejects off this level again. So this is a high rejection level. So you will put your stop loss right above this level. Now let's look for another example. And we are still bearish. What are we looking for? We're looking for price to be met with extreme demand, or then price to be met with extreme supply. So you want to pull out your fib. This would be your extreme supply. And as far as your stop loss, again, same thing. This would be your high rejection level. So let's make it dark. Your first TP would be right below this level. And for your second TP, always can look to the left and find another level of external liquidity and take price down there. Now, why is our stop loss pretty huge? Because what we're trying to avoid here is, yes, price is rejecting from a extreme demand, going to an extreme supply, and we're expecting a rejection. But what could also happen is Wyckoff price could take out this liquidity and then distribute. And this would be your climax, this would be your test, and this could be a purge. And to avoid this, by taking a small loss and then for price to go the way that you intended, you want to make sure your stop loss is a little bit wider. So we're trying to avoid a Wyckoff setup. And as you can see here, price did take out the liquidity. Didn't close above your extreme level, but did wick out to try and grab liquidity for the last time before distributing. Now your first TP. And this is the only logical level of liquidity. So as you can see, there's two ways to trade this strategy. One way would be an aggressive way, one way would be a conservative way. So an aggressive way, the benefits is it would occur more often. So The aggressive approach would be price rejecting from your, obviously this is in a downtrend, so price rejecting from an extreme demand, reaching your extreme supply here, and you're taking the entry once price approaches this level here, and you're taking the entry. And this happens pretty frequent throughout the market. Now, a conservative approach, which would be the safer and the high probable, but the only issue here is it doesn't happen that often, is if, let's say, in a downtrend, you're looking for a rejection right here, and obviously you're targeting the initial supply, extreme supply level here. But in this case, your target is this level of liquidity. You're waiting for price to take out this liquidity and drop down and close. Once price closes, now you have a high probability trade all the way down here. The only issue here is if you're trading in a conservative approach, you will miss out on a lot of trades. So let's talk about positioning. Where would you want your compression to occur? So as you can see here, price broke structure to the upside after taking sell side liquidity. And obviously we are in a bearish trend. So you would want your oppression to occur above the structure break. This would be your compression. So let's take a look at this example. So what do we have here? We have a bearish trend and we have our micro break of structure right here. So what are we looking for now? We are looking for a compression or character change. As you can see, prior to this, you can see clear structure. So you can see it's making a swing high, a swing low. So you have a double external cleanup and now price breaking structure. So now you expect a micro change of character until price can affirm a direction. You can see instantly profile changed. So the range is a lot tighter. What do we have here? We have a rejection. See if it closes below or, okay, so now you have a rejection. So obviously your target would be this order block right here, which would be in perfect line with your extreme. So this order block perfectly aligns in your extreme supply zone. And obviously your stop loss would be at a rejection level right here. Okay, so this one worked out. Now let's look for another compression. Okay, so what do you have here? You have price being met with extreme demand. And now you are waiting for your extreme supply, which in this case, you have this order block right here. Now you can pull out your fib and double check if you're not trusting your eyesight. Now price went from extreme to extreme. So you have two options. You can take the conservative approach, which is waiting for a stop line. So waiting for this liquidity to be taken and for them price to close back inside of the range. You can take the trade like that, or you can take an aggressive approach, which would be instantly trading off a contact with your extreme supply. And where would your stop loss be in this case? So you would look right above here and you would see what's the closest rejection level. So you stretch it out and you see where price been rejecting. And as you can see here, this price been rejecting heavily at this level. Price rejected here once, twice, 3, 4, 5, 6, 7. See, this is a high rejection level. So your stop loss could go right above here for your aggressive approach, and for your conservative approach, obviously you would wait for a stop line, and once price closes back, you would mark up this as your high. So this would be your stop loss, or liquidity sweep would be your stop loss. So let's look at it from a rejection standpoint. And your first stop loss would be clearing out this clean traffic right here. So this would be first take profit. Your second take profit would be completely closing down the range. You're looking for something like this. Your first TP, second. So now let's look at this example. So what do we have here as far as context? As far as context, we have a macro sweep. So if you go on your 12-hour time frame or your daily time frame, this will be a macro sweep. Those sellers being trapped. So now we are on the micro. And what do we have here? We have a extreme supply level. And the reason we don't simply mark up this level because this is the entire area. If you just simply target the order block, you're going to miss out on the entire zone. Let's take a look at this reaction. What do you have here? You have inside of your micro, you have a rejection from an extreme, from your extreme supply, and now price is approaching extreme demand. So what happened in this area? You have your macro supply. And as you can see, the trend is changing into bullish. When price approaches this level once and drops down, sells were already used to bring price down. So when price approaches this level for the second time, you can anticipate there's less sell orders. So now in the micro, when this supply level is met again with your micro demand, along with the initial trend and your sellers being trapped as your macro context, you are expecting price to continue to the upside with this demand level being the catalyst. Now you're using this demand level to overpower this weak macro supply level and this micro supply level. Both had contact already. So in case you're still confused, think of it like this. So let's say you have your bullish trend right here and price approaches this level. You already understand that the demand level is more dominant in a bullish trend. So let's say here you have your supply level. Now this supply level is tested once and whatever sell orders in the supply level were used to push price to the downside. So now on your micro time frame, price approaches this level again and rejects. So if you already know that the dominant force here would be your demand and you have a squeeze, which is your compression right here in a weakened supply level where you had contact and the sell orders already used and you are already in a bullish trend, understand that this demand level will be extremely powerful, more than likely be used to break out of the entire structure. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you use code BLACK5 for your 40% off Black Friday sale.